What about this type? It's a camera. Yeah. So, good morning, everyone. I'll wait for another 2-3 minutes and then I'll start. Hope I'm audible for everyone.
Yes, sir.
Okay, so we start now. Okay, so we start with the yesterday's question. I'll just write some information on a Excel. Okay, so if you see, like the lease rental per year is 5,000. Okay, so year 1, 2, 3, and 4, which is 5,000. Okay, and the residual value which we supposed to get on expiry of the lease, it is given 8,700. Okay, so these are basically the future cash flow for the lessor. Okay, so now he can decide what would be the present value. Okay, on the basis of discounting factor. So discounting factor is basically the 6%. Okay, so it is 1 divided by 1.06. Okay, and then if I copy this, so these are my discounting factors. And then the same amount. Okay, so present value of all future cash flow is this one. Okay, this is basically 24216 is my present value of all future cash flow. Clear with this? Okay, discounting factor and the present value. Okay, so that is my present value of all the future cash flow. So what does it mean? I gave a loan of 24,217 and I may expect a 6% interest over my loan amount. Okay, so that is basically the like conclusion with this approach. Okay, so or initial amount that I need to keep from here. Okay, if I calculate the 6% interest, okay, and then a repayment of 5,000 EMI. So my closing balance is this one. So you can see here 1, 2, 3, 4. Okay. Then again, this is okay. So this is initial amount, then interest. Okay. EMI paid or EMI receipt in this case, and the closing balance. Okay. And if I consider this, Okay, sorry. Okay. I'll just explain. Okay. So here, if you see in this table, I first calculated, hope I am audible properly. So first calculated the discounted value of all future cash flow, and this 24217, which I considered, I mean from lessor type, lessor side, it is basically loan given to lessee or the finance given to lessee. Okay, so if I gave a 24217 as a finance, okay, and I'm charging interest at 6%, okay, and I'm getting 5,000 as an EMI in first 3 year, and in a fourth year it is 5,000 plus 8,700, which is the terminal value, this one. Okay, so this will give me the closing balance of like at the end of first year it is 2670, at the end of second year 16910, at the end of third year 12925, and then like once I get the 13,700, it is zero, balance is clear. Okay, so are you able to understand? Means see what happened. First we evaluate whether it is a finance lease and or operating lease. Once we evaluated, okay, it is a finance lease, then it is from lessor side we are just giving a finance. Okay, so we need to know what is my finance value. So I know the expected interest rate. Okay, so if I discount with the expected interest rate for all future cash flow, then I will get the present value of the future cash flow, which can be considered as the finance given by the lessor. Okay, and if I prepare this amortization table, okay, so or the interest calculation, so it get exactly match. Okay, so we are aware on year to year basis how much lessor earning as an interest and how much amount he is supposed to get against the loan. So in first year it is basically the 3546. Okay, because he is getting a 5,000 including interest. Out of this, he is paying 1453 as an interest. Okay, so remaining amount need to consider as a repayment towards the principal. Okay, so this way we need to do it. Okay, we'll see one by one the entries. Okay, so asset book value is 22,000, it is given. Okay, and 24217 is basically carrying value and the fair value. Okay, and here like our fair value is also 24217. So it is basically I mean discounted cash flow of all discounted value of all future cash flow. Okay, 24216. It is 24216, 24217. Okay, now we start with the journal entries. So first we need to de-recognize the asset. Okay, so for that they incurred the lease expenses of 450, which we paid in a cash. So lease expenses account debit to cash account credit. Then whatever may be the financing amount, okay, which we calculate like this. Okay, it is given in the question. Otherwise you need to calculate like this. Whatever the present value of all the future cash flow. So it is 24217. So it is my lease receivable. Then we need to de-recognize the asset, and whatever may be the difference in lease receivable and the de-recognition of the asset, that goes to the gain. Okay, then like when I get the first installment, okay, so interest income is 1453 because we need to calculate the 6% on full amount in a first year. So 1453 is my income in interest income, and the remaining is basically repayment of the finance. So it is adjusted against the lease receivable. So it is credit and the lease receivable here it is debit. So closing balance is 24216 minus 3547. And this is basically the amortization table which I just created. Okay, anyone has any issue with this, or you are able to understand? So in finance lease, first thing, whenever there is a certain lease transaction, then you need to first evaluate whether it is a finance lease or the operating lease. If it is a finance lease, okay, so you need to consider it is basically we sell the asset, okay, and whatever the lease receivable, that is basically the finance to the lessee, okay, and accordingly you need to do the calculation, okay. So you can calculate the present value of the lease receivable, which can be considered as the finance given to the lessee, and then you need to prepare the table like this, okay, so that you can decide means what would be the interest and how much amount you need to adjust against the lease receivable. So for that you need to prepare this table. Okay. Any doubt here? Okay. So direct finance lease. So direct finance lease, the lessee does not gain the control of the underlying asset. Thus, lessor will de-recognize the asset and recognize net investment in the lease. Okay. So the net investment in lease include the lease receivable and the residual asset. Any gain will be deferred and amortized over the life of the lease, and any loss will be recognized immediately. Okay. So, direct financing lease, basically in this situation, it is as good as the finance. Means if you have a right to purchase, okay, so that we need to consider as a finance lease, okay. But in that situation, because unless and until the lessee is not exercise his right, you cannot say this is basically the sell. So you are going to de-recognize the asset, but whatever may be the gain or loss, instead of recognizing immediately loss, you are going to recognize immediately, but gain you need to be defer. So in each period end, the lessor will recognize interest income equal to discounted rate applied to the investment. So that we already discussed. Okay. And here the gain adjustment is not given. We will see the example. So in this example, Jenkins Inc. lease a truck to a bricks company for the 4 year, 5,000 per year with the payment due at the end of the year. The lease has an implicit rate of 6%. On the date, this lease commences January 1, year 2. The carrying value and the fair value is 22,000 and 24,216. The lessor has contracted with the third party to guarantee the residual value of 8,700 at the end of the lease. Okay. So this you are going to de-recognize the asset with the 22,000 only. Okay. Lease receivable is 22,000. Okay. So here you are not going to recognize the gain immediately. Generally, we need to calculate lease receivable as a lease receivable as a present value of future cash flow. Okay, but in the because it is a direct finance lease, so you are not going to recognize the gain. Okay, so whatever may be the carrying value of the asset, that you need to transfer to lease receivable. Okay. So here if you see, so in this situation, I need to have here the 22,000 basically. Means if you see, I mean, how I am going to calculate this amount, I mean, this percentage 9.6299, that you need to understand. Okay. So, like, okay. So, like 22,000, this should be, means I need this value as a 22,000. So, 5,700. .63%. Yeah. Okay. So again, because keeps on continuously disconnecting line. See, if there is a direct finance lease, so what we are doing, we are not recognize the gain immediately. Okay, so what we are doing, we are carry forward or amortize the gain over the lease period. Okay, so whatever may be the my asset value that I need to consider as a lease receivable, and then we need to calculate what would be my interest income. Okay, so whatever may be the future cash flow. Okay, so present value supposed to be the asset value. I mean the discounting factor I need to use which give me the present value is equal to the asset value of all future cash flow. Okay, so that I calculated here. I consider the 9.63%. Okay, so this way you can calculate. Okay, so I mean this is now your table. Okay, so if you see 2119, yeah, 2119, this is okay. So my entry is basically whenever I am receiving a 5,000, I need to recognize the interest and whatever may be the difference that I need to adjust against the lease receivable. Okay, on a sales type lease, I am going to recognize the gain immediately. But in case of the finance lease, I am going to recognize the income over the period of lease. Okay, so finance lease is mostly when the lessee is ready to purchase the asset. Okay, so that is basically means if you see like yesterday's finance lease. Like this one means when there is I means if we consider that we are not going to transfer the ownership or like we feel that this is not the sales type because if this five conditions are not met. Okay, then we go for this two condition. Okay, if this get met, okay, so then we need to consider this as a direct lease. Okay, so like the for qualify as the sales type lease, we means the ownership is the condition, written option given, and it is expected that the lessee is going to buy the asset. Then the net present value of all the lease payment and any guaranteed residual value equal to or exceed the substantially or all of the underlying asset fair value, and then maximum economic life used by the lessee, and the asset is like the kind asset is such that type of asset is such that it is used by the lessee, there is no alternate use. Okay, so if this any one of the five conditions are met, then we need to consider sales type lease. If the any one of I mean if the all I mean no condition will be met out of all this five, then we need to further evaluate whether whatever the lease payment we are receiving, okay, that exceed the asset value including the third party guaranteed residual value. So if this is the case and the collection is probable, okay, or certain, okay, so in that situation we need to consider this as a direct finance lease. In sales type lease, we need to recognize the gain immediately. In direct finance lease, we need to defer the gain. And if we are deferring the gain, okay, so that means the asset value, carrying value of the asset is equals to lease receivable, okay, because we are deferring the gain, okay, we are not recognize the gain immediately. And accordingly, you need to calculate what could be the interest amount. Then we go with the operating lease. In operating lease, I mean, if the particular lease type is not, if the particular lease type is not the finance lease, then it is an operating lease. Okay, so it is simple for in an operating lease, whatever may be the rent received, it is rental income for the lessor, and as he is not de-recognizing the asset, so depreciation expenses he need to recognize. Okay, so that is basically the operating lease in the books of lessor. Now we need to see the lessee accounting. So in operating lease, okay, so here what happened? The concept of right of use. Okay, and corresponding lease liability. That we need to recognize. Okay, and that amortize over the life of the lease using the effective interest method. Okay, so the ROU asset and the lease liability amount are calculated using the net present value of the lease payment and using the appropriate discount rate. So on the income statement, lease expenses will be recognized each year over the lease term using the straight line method for the expenses measurement. Instead of reporting interest expense on the income statement, the lessee will report the interest as a part of lease expenses. Okay, so in short, whatever may be the interest, that is also the part of the lease expenses. Okay, so if you see, okay, so initial entries basically, like again the cash flow we need to consider whatever may be the discounted present value, that we need to recognize the ROU asset and the corresponding lease liability. In subsequently, whatever the lease expenses, okay, that is including the liability, that we need to reduce, and the cash lease liability, okay, and the lease liability and accumulated amortization or ROU asset means again the corresponding effect, the like whatever may be the like EMI which we are paying. Okay, so say for I mean I'll give you the detailed calculation, but before that, okay, say for how I can take this example, or we can take the example of this example. Okay, so 5,000 I need to consider as the lease expenses because it is the EMI as well as the interest. Okay, that is my entirely lease expenses. But over the period, my liability is reduced 19,119. Means instead of 22,000, I need to reduce it to 19,119, and the same corresponding effect I need to give on a ROU asset. See what happened when I recognize the 22,000 as my lease liability or right of use asset. ROU asset. Okay. So that is basically the 22,000. This is I calculated as a discounted value, and then there is a lease liability. Okay. So this is the again 22,000 credit. After 1 year, whatever may be the EMI plus interest. Okay. So that I need to consider as a lease expenses. Okay, lease expenses, which is basically the this lease amount. Okay, and the cash account credit. Okay, why the cash account credit? Because we are considering the books of lessee. Okay, but what is my closing ROU asset lease liability? Is not like this 22,000 minus 5,000. Okay, it is only 22,000 minus interest expenses. This one. Okay, and the same amount I supposed to get here. Okay, I'll modify this table. So if you see, okay, so this is basically my EMI. Okay, I need to recognize in the books of lessee for in the books of lessee for operating lease this amount as a full 5,000. Okay, this is my lease expenses. Okay, but my closing balance or like lease liability and the right of use asset, only I need to debit this one, not the 5,000. Are you clear with this? Anyone? I mean, anyone has any doubt here? Okay, see what happened. This is my say for the present value of the asset. Okay, so that I need to recognize as a present value of the all future payment of the lease. That I need to recognize as a right of use asset and the corresponding lease liability. Okay, so whatever may be the my lease expenses is basically the EMI, like the lease payment I am making, which is interest as well as kind of EMI or against the principal. Okay, but the closing balance of the right of use asset is basically the only the interest component, not the EMI component. So it is this way we need to calculate. We need to reduce the interest component, and then further we need to reduce. Sorry, it is not the interest. It is basically the EMI. Sorry, this one. Yeah, so it is not the interest. We need to reduce the EMI portion. Okay, I did the calculation properly. The wordings are wrong. Okay, so in from initial amount, I need to reduce the like the amount which is payable against the principal. Okay, and then I need to show the closing balances. Clear with this? We will see in an example. So lease liability and accumulated amortization ROU asset. Okay, so that we need to reduce it. So if you can see this example, on January 1, year 2, a lease enter into 3-year asset operating lease for annual payment of 18,000 per year. The first payment will be made on 31st December and the interest rate implicit is 5.75%. So the present value of ordinary annuity 5.75 is 2.6825, 2.685424. So I'm preparing the table here, or I'll keep it. Okay, so first 2, 3. How much is the lease rental per year? 18,000. Then discounting factor, 5.75%. 75. So 1 divided by 1.0575. Okay. So present value is, so that is my right of use asset. Okay, 48337 or 408. So entry is right of use asset debit to lease liability credit. Liability credit. So this is debit and this is credit. Clear? This is my first entry. Now I need to calculate, I mean the second year, this table I need to amortize in reduction in ROU asset. So that I need to amortize. Okay. I start with this one. So initial amount is basically 48,387, interest 5.75%. Okay, EMI we need to see. So EMI receipt means it is payment, which is minus 18,000 payment. Okay, so my EMI here is this plus this. Okay, so if you see, this together 18,000. Okay, and the closing balance is this minus EMI portion. Okay, so that 15 to 20 I need to reduce from the ROU asset and the lease liability. Okay, so same is here. Balance is 0. Okay, now you can see. Yeah, more or less. Okay, so in at the end of the second year, lease expenses is 18,000. Lease liability need to reduce by 15,221. This is my EMI amount reduction in asset. If you see, this is what 15,221. So my closing balance in lease liability and ROU asset is 33,117. Okay, and then the accumulated amortization ROU asset 15,221. So in balance sheet we need to show like this. ROU asset, so full amount 48, what is this? 48,337 less amortization ROU, which is 15,221, and the closing balance. And the corresponding effect means 15,221 corresponding effect given to the lease liability. This way we square off the transaction. Okay, so lease liability debit means liability we are going to reduce it, and we are charging accumulated amortization ROU asset, so that the net ROU value is also get reduced. Okay, so this way we need to calculate. In the year 3, same 18,16096 lease liability, and the accumulated amortization 16096, and the cash we need to credit 18,000. So this way we need to calculate. That is for operating lease. Clear? And this entry we pass in the books of lessee. Anyone has any doubt here? Okay, then finance lease. Okay, in the finance lease, again the same thing, ROU asset, lease liability, but here we need to recognize the interest expenses separately and the lease liability separately. ROU asset as it is, okay, and the amortization expenses and accumulated ROU asset. Cash. So here we are recognizing the expenses, and the amortization expenses is basically 16113, which is like difference in total lease expenses and the interest expenses. Okay, so that is basically the amortization expenses. So that we need to reduce from the lease liability. Sorry, ROU asset. Okay, so it is just like a we are calculating the depreciation. I just do it like this. Okay. So this we need to reduce from the lease liability. Okay. But like means my entire lease expenses I need to consider because the asset amortization is on the basis of 48337. Okay. So it is like I'm just adding one more table. Okay. So this divide by 3. Okay. So lease expenses means lease amortization I am going to reduce equally, but the liability I am going to reduce with this amount, that you need to keep in mind. Okay. But the ROU asset I am going to reduce it with this amount. In operating lease, the same amount I am going to reduce from lease liability and the ROU asset. Okay. But in finance lease, I need to reduce the ROU asset equally, like straight line depreciation or the amortization. Okay, so like if you see the total 48337 and the 48337, total is same. Total is same. Clear? So that is basically the lease amortization means ROU reduction. Okay, and this is lease liability reduction. That is the difference. Okay. In operating lease, we are using the same amount for lease liability reduction and the ROU reduction. But in finance lease, ROU, I mean the right of use of asset, we need to reduce equally. Okay. So that's why the amount is different. So first year in the books of LEC, operating lease expenses is basically 18,891. Okay. Second year it is 18016, and in the third year it is 17091. This way we need to calculate. Okay, so here if you see lease expenses 2779, lease liability 15221, and the cash is 18,000. Amortization expenses is just like a depreciation, so 16113, and accumulated amortization ROUS is 16113. Second year you need to pass these two entries, and the third year again you need to pass this two entries like this. Okay, if you see we are reducing the lease liability is with the same amount, and the same amount we are reducing in ROU asset. Okay, so it will not affect. Okay, so at the end of the lease tenure, the lease liability balance is zero and ROU asset balance is also zero. Okay, the only thing is that in finance lease, we are equally amortize the amount. In operating lease, whatever may be the lease liability reduction, that we consider as a ROU reduction. Okay. So reporting a lease, okay, combining contract. So on January 1, year 5, any doubt till now? Means hope you are able to understand the difference in operating lease and the finance lease. Anyone has any thought process going on thinking? Okay. So example 5 we will see. On January 1, year 5, the lease enter into 8-year asset finance lease with an option to extend for the 4 years, which the lease is unlikely to exercise. Initial lease payment are 35,000 per year for the first 8 years, with a payment on January 1 each year beginning in year 5, and then 40,000 per year if the lease is extended. So initial direct cost incurred by the lessee are 12,000, and the interest rate implicit in the lease is 4.5%, and the lessee's incremental borrowing rate is 5%. Okay. So you can see, prepare the journal. So cash payout 35,000 for first lease payment and 12,000 for the initial direct cost are recorded, as well as the present value of the 7 remaining lease payment. So here, because we are giving in advance, so we first need to reduce, and then the remaining value we need to consider as a ROU asset and the lease liability. Okay. So lease liability is equal to the present value of 35,000 per year for the next 7 years, as then interest rate of 4.5%, which is given. And because the company is unlikely to extend the lease of the 4 year, not considered in calculation of the amount. 7 payment of 35,000 at the rate 4.5% equals to the 206,245. So the ROU asset will be the combination of this 3 item. Okay. So like 35,000, okay, for 8 years in advance. Okay, so ROU asset equals to first 35,000 plus present value of 35,000 for 7 years. That is ROU asset. But the lease liability we are calculating at year end, because we already gave the 35,000. Okay, so it is present value of 35,000 for 7 years. Okay, so that you need to consider. So ROU asset, it is given 206,245. Okay, or we need to calculate. Okay, so 35,000, if I calculate 1, 2, 3, 4, 5, 6, and 7. Okay, so cash flow, which is 35,000 for 7 years. Discounting factor, okay, which is 1 divided by 1.045. Let's say, okay, what is my present value? 1,77,000. What happened? 206. 7 payment of the at the rate of 206, 2.5, 4.5. Oh, Yeah, 206, 244. So this way we need to calculate. Okay. So that is my present value of all future cash payment. Okay. And for ROU, because I'm paying in advance, so this is my ROU, 241, 240. Okay. And this is my lease liability. Lease liability. Okay. So here if you see ROU 253, 245. Why? Okay, 12,000 cash. I mean, the initial expenses is also 12,000. First lease payment or the initial direct cost. Okay, so that also I need to add. So whatever may be the cost incurred, that is also the part of asset. So that's why it is 253, 244. So upfront we pay 35,000 plus 12,000. So that's why we need to add. So cash account credit and the ROU asset 253, 245. ROU asset includes all lease payment and the direct cost. Okay. And the lease liability means whatever may be the future outflow. Okay. So present value of that future outflow. So this way we need to do this entry. Okay. Hope you are able to understand. 35,000 means if I discount the 35,000 for 7 years, I got the 206, 244. This is my lease liability because the 35,000 I am paying an upfront. So remaining cash flow I need to consider for a lease liability. And the asset is basically whatever may be the value or the amount I am paying for the acquiring the asset on a lease. Okay, so that's why what the direct cost as well as the upfront payment that I need to add in a lease liability. So it is 253, 244. So I hope the first entry is clear. ROU asset 253, 245, lease liability 206, 245, and the cash is 47,000. Next. Okay, so that I will see later on. Okay, in this question, whatever may be the upcoming period, I mean the extended lease period that we have not considered because it is not probably certain. Okay, so that also you need to keep in mind. In the second, like here, the same question, which payment of beginning year 5. And then if the lease is extended, initial direct cost incurred. Okay. So calculate the interest, the amortization liability and the amortization of the asset, assuming straight line and the total lease expenses for year 6 when the first lease payment is made in January year 5. The lease liability is immediately reduced from 2041 to 206,245. That is okay. What they gave here. Okay. Okay, so reduction of lease liability. The 1 year 7 represent interest accrued in a year 6 and okay equal to the lease liability. Okay. Okay, so in a for year 6 will be equal to year 6 means the second year. Okay, so what is my lease expenses for the second year that they inform to calculate? Okay, so I'll start with like lease liability 206. This one. Then I need to calculate the multiplied by 1.045, 4.5%. This is my interest. Okay. And like if I amortize over the 8 years, okay. So 253, 244 is my ROU, okay. And then divide by 8 in a straight line method, okay. So this is basically the liability, opening liability. This is the interest for a first year or the interest for the period, and ROU amortization on a straight line basis. Okay, so it is 253 divided by the 8. Okay, so what is my lease expenses? This one, 40936, 39,780. Okay, 8124. They calculated for the year 7. I calculated for this one, 9281. Okay, so I'll go once again. So this is my lease expenses. Lease payment is 35,000. So closing balance is, this is my opening plus interest and plus the lease payment. That is my closing balance, 180,000. Okay, and if I calculate again for second year, this is my interest. This is ROU asset. ROU asset as it is same. Okay, so total lease expenses is 39,770. This is my lease payment and this is my closing balances. Okay, so for this year, this is basically fifth year, this is sixth, or this is sixth year, this is seventh year, 8, 9, 10, 11, 12, 7 years. Yeah, so this is what we need to calculate. So 39,779, let's see, 39,779, like this. Okay, so that is my lease expenses. This way we need to calculate. Okay, are you able to understand what I'm doing here? See, opening liability I calculated on the basis of the future cash flow. Then I charge the interest. ROU amortization is on straight line method. So ROU value I calculated on the basis of whatever may be the present value of the future cash outflow plus upfront payment. And then my lease expenses is basically the interest and the ROU amortization. Okay, lease payment is 35,000. So reduction in the lease liability. Okay, that is basically the 35 minus 9281 because this is an interest. So that is my closing balance and closing lease liability. So closing lease liability become an opening lease liability for the next year. Then I need to calculate the interest. ROU I need to amortize over the straight line method. Lease expenses is ROU amortization and the interest paid. Okay, the lease payment is 35,000 and the closing balance is again opening lease liability plus interest minus lease payment, which will give me the closing lease balances. Anyone has any doubt here? Are you able to understand or just listening?
Sir,
Yeah,
sir, actually, the screen what we have seen now is not matching with what you are telling. Actually,
just a
you
minute.
are
Okay. Understood. Just a minute. There may be a certain. Okay. Bapre bap. Okay. So since because see okay, it may get hang. Okay. Okay. See, if you find any difficulty or the screen is not rotating, just raise your voice. Okay, otherwise I'm not able to understand. Okay, so where we can start again. So see, are you clear with this concept? But okay, you have not seen the screen, so it is difficult for you people to say. Okay, I'll try to explain once again. Okay, we'll start with this problem again. Okay, right now we are just thinking on from the LEC point of view. Okay, so this is basically the first question. Again, we will see. On January 1, year 2, a lease enter into the 3-year asset lease with an annual payment of 18,000 per year. The first payment will be made in December and the interest rate implicit in the lease is 5.75%. So lease qualifies as a finance lease. So assuming straight line amortization, we need to prepare the journal entry. Okay. So first we need to calculate what is my lease liability. We are talking about the operating lease at this moment. No, sorry, finance lease. Okay. So in finance lease, okay, so you need to consider this one. In finance lease, first we need to calculate what is my present value. So it is 448,337. Okay. So my asset and liability is 48,337. Okay. So if I consider if you see here, so 48,337 is my initial investment. So it is my lease liability. Then I am getting an interest, then EMI and the EMI payment, and which will give me the closing balances. Okay. So this way we
Sir,
need, yeah.
sir, one of your video is not connected. I think your notes.
Okay. Yeah. Okay. So here what happened? I means like 48,337. This is my initial liability. Then I calculate interest and whatever may be the lease payment I did. If I reduce the interest, then this would be my EMI. Okay. So in operating lease, what we do, whatever may be that reduction from the lease liability, that we reduce from the right of use asset, okay, ROU, okay. But in finance lease, we need to reduce a straight line method. Like here we are doing it, lease amortization 16,112, that we do in a finance lease. If you see, the total is same, okay. The only thing is that lease liability reduced by a EMI amount, and the amortization ROU we are reducing on a straight line basis, okay. So this way we are reducing the liability. This table you need to understand that I calculated on the basis of, first I calculate present value, which is my basically the finance given to the lessee, okay, or from lessee point of view, it is basically the finance we got, okay. And then whatever may be the interest expenses plus lease amortization, that is my total lease expenses. So 2779 plus 16,112 is my lease expenses, and the reduction in the lease liability and ROU is basically, in finance lease, it is the EMI amount we need to reduce from the lease liability, and ROU asset on a straight line basis we are going to amortize. But in operating lease, we are reducing the same amount, means the EMI amount we need to reduce from lease liability and the ROU asset. Okay. So I'll just like and the ROU. Okay. Operating lease, it is EMI amount. Okay. We need to reduce. But in a finance lease, it is EMI, but here amortization on straight line method. Okay, so that difference you need to keep in mind. We are talking about the as per the lease point, lessee point of view. Okay, so for you, lease expenses is basically interest plus amortization. Amortization. If this is the situation, okay, so total EMI is basically the lease expenses for an operating, not total EMI, lease payment, entire lease payment. Okay, but in finance lease, the lease payment cannot be the expenses. It is more or less expenses because of straight line amortization. Straight line amortization. Okay, in a finance lease. Okay, so if you see the operation lease, because we are reducing the same amount in asset as well as the liability, so this too is my lease expenses. Okay, in an operating, but in finance lease, ROU we need to amortize over straight line method. So that's why the interest plus lease amortization, which is less than or greater than the EMI lease payment. Okay, so that is my amortization. Okay, so here if you see, it shows the excess 18,891 excess, but even if here if you see, it is less than 18,000. So over the period it get compensated, but this is basically the way of recognizing the lease. Okay, in a second question, like it is an advance, we do the like lease payment in advance. Advance. Okay, so it is an 8-year lease. Okay, first year is advance 35,000 plus 12,000 direct expenses on the lease. Okay, and second year onward, it is 35,000 lease payment for 7 years. For 7 years. Okay, as first year advance I am paying, first year lease payment I am paying in advance. So first year is not basically the part of the lease liability. So what I need to do, I need to calculate for the 7 outwards. Okay, present value of the 7 outward, and that is my lease liability. But ROU I need to consider whatever may be the lease liability plus the advance amount 35,000 plus 12,000. So it is lease liability is 206,244, but the ROU is basically 253,244. Okay. Now we are talking about the finance lease. So we need to, what we need to do, we need to calculate, we need to consider opening lease liability, then whatever may be the interest, ROU amount we need to amortize over the straight line method. So 253,244 divided by the 8. That is basically the ROU amount. Lease expenses is interest plus the ROU amortization. Okay. Then the lease payment is 35,000. So this will give me the closing balance. So I need to reduce basically means lease payment. So it is means I need to reduce from the opening lease payment, whatever the opening lease liability, whatever may be the lease payment minus interest, because in this 35,000, 9281 is interest. So remaining amount means 30 minus 35 plus 9281. That is basically my repayment towards the lease liability. So I need to reduce the 25,718. Okay. So here if you see, like I added C57 and F57. So it is basically the lease payment as well as the interest. Okay. So net amount I need to reduce from the lease liability. In a second year, I did the same thing. Okay. Now for the third year, this is my opening lease liability. Okay. I need to calculate the interest at 4.5%. ROU asset amortized in a straight line method. So my lease expenses is ROU asset and the interest. Okay. Lease payment I did the 35,000. Okay. Closing balances. This is my opening balance. Plus I need to pay the interest. So my liability get increased. But then I make some repayment of the lease payment. So closing liability is 125. Okay. The same way again, this is my closing lease liability. I calculate the interest, ROU amortization, lease expenses is ROU amortization plus interest for that period. Okay, I paid the lease payment, and the closing liability is again opening liability plus interest minus 35,000, which is 96,213. So I now just do the copy paste for next remaining period. So here you can see the balance is 0. Your lease liability is 0 plus amortization. If you see this, okay. So for all the 7 years, it is 2 to 1. I mean, at the end of the period, because we calculate the for the 7 year only. Okay. So if you see the closing balances, that also get knocked off 253 and the 7 and the 8 period. This is for 8 period. So at the end of the form period, it is 253, 244 that get reduced. Okay, because this is for second year 31,665. Actually, it should be like this. In the first year also 31,655.56. So this is my 253, 244. Okay, so this way 253, 244. This way my asset also get amortized. Okay, so this way we need to do. Any doubt here?
So can you share this Excel, because we don't have all 8 to 10 years data in the records module.
Okay, I'll share the Excel, no problem. Once the class is over, I'll share the Excel. Okay. Then reporting of the finance lease that we just saw.
In exam, how will the question be arise, sir? We have to do the journal entries and even this
No,
Excel.
it is basically the selection actually. Means MCQ you need to solve. Okay, so today I'm going to take the practice as well once this topic is over. So mostly they just ask, like here in this question, they ask for the second year expenses. So you just need to prepare the table and you need to find out this amount like this. Like 8124 means what is the expenses for the year 7. Okay, so that way you need to calculate. If you see this example, so here the like they ask for interest expenses, the amortization liability and the amortization of the asset and the total for the year 6. Okay, when the first lease payment is made on January year 5. Okay, so the lease liability is immediately reduced from 241 245 to 206 245. Okay, so they just ask this. Okay, so the payment made on January 1 year 7 represent the interest expenses occurred during year 6. So the year 6 interest expenses is 8124 like this. So that we need to calculate. Expenses is a front loaded as an interest expenses plus asset amortization will create the higher total expenses than under operating lease. So in the latter year, a finance lease will reflect a lower total expenses than an operating, which we just discussed. Okay. So in finance lease, the lease expenses in the earlier period is higher and the latter period is lower because we are amortizing the ROU on a straight line basis. So earlier period, interest is high as well as ROU is high. Okay, but in latter period interest get reduced, so that's why the lease expenses is less in latter period in a finance lease. Any doubt here? Then accounting policy elections. So LEC can make the accounting policy election and choose to not recognize ROU asset and lease liability for the lease with a term of 12 months or less. Means if it is an operating lease, so they can decide not to recognize ROU and the lease liability. Anyhow, in a reporting period, it gets square off. If the election is made, it must be done by the class of the underlying asset and cannot include purchase option for the asset the lessee is reasonably certain to exercise. Okay, so if you are planning to exercise the purchase option, okay, so then you cannot elect the the accounting policy. Otherwise, for a 12-month, if the lease tenure is less than for a 12 month or less than 12 months, in that situation, you can decide not to recognize ROU and the lease liability. Then sale and leaseback transaction. A sale and leaseback occur when one party, the seller, that has control of an asset, transfer it to another party, the buyer. Okay, buyer, and the subsequent lease of the same asset where the seller become the lessee and the buyer become the lessor. So having control of an asset means being able to direct its use, obtaining substantially all its remaining benefit. Okay, so like seller sell asset to the buyer, and then it is coming back to lease. Okay, so a asset is again used by the seller. Okay, so how we need to consider? So asset transferred from seller to buyer, an asset leased by the seller, now the lessee, and from the buyer. So asset still is under the control of the seller. So to qualify as a sale, revenue recognition requirement must be met. In particular, where a contract exists and the control transferred from the seller to the buyer. If the asset transfer does not meet this requirement, this will be treated as a financing transaction. Means if you are using the asset for remaining life, then you need to consider as a financing transaction. Okay. So if an asset transfer involve either of the two key situations below, the transfer may or may not be considered as a sale depending on the circumstances. So first is repurchase option. So to meet the criteria for the sale, both the following must be met. The option exercise price already is or will be the same as the underlying asset fair value at the time of exercise. Alternatively, assets that are substantially equivalent to the underlying asset are readily available in the marketplace. If both these criteria are not met, the existence of the repurchase option will result in the failed sale, and this will be treated as a financing transaction. Means if these two conditions are met, then you can say it is a sell. If these two conditions are not met, means if you see the first one, the option exercise price already is or will be the same as the underlying asset fair value at the time of the exercise. Okay, so whatever may be the fair value, okay, okay, of the asset, okay, so that would be the repurchase price. Okay, so that means like the buyer need to buy the what happened here, equals to repurchase price. Okay, so in that situation, what happened? At the time of repurchase, he need to pay the fair value of the asset. So that's why means we can consider this is in a current period. It is basically the sale. Okay, if the fair value of the asset is or the repurchase price is less than the fair value of the asset, that means in a lease rent already we consider some of the repurchase price. Okay, so and if this is the situation, then you can consider as a finance lease, because we are paying the value of the asset to the like buyer or the lessor. Okay, so that you need to keep in mind. I mean, if the fair value of the asset is equal to the repurchase price, that means the valuation means the lease payment is not considered, or we while doing a lease payment we are not consider the part payment for the sell transaction. Okay, in second case, alternative asset are the substantially equivalent to the underlying asset are readily available in the marketplace. Okay, so it is not basically the asset used by the lessee only. Okay, anyone can use the asset. Okay, so if these two conditions are met, then we can consider this as a sell, or we need to if these two conditions are not met, then we need to consider this as a financing transaction. Okay, so that you need to keep in mind. Okay, then residual value guarantee. A sale cannot take place if the control of the asset has not been transferred to the buyer. If the qualitative judgment, it is a qualitative judgment, but the more significant the guarantee, the more unlikely is that the control has transferred. Okay, so if I am giving a guarantee, means like I am going to give a guarantee of the repurchase, that means I am not going to transfer the control of the asset. Okay, so if this is the situation, then again we cannot consider this as a sale transaction, sale or leaseback transaction. Okay, so in first repurchase option, if I need to pay the fair value for buyback, okay, so that means like my EMI or the lease payment is not, we have not considered the repayment of the asset in my lease payment. Okay, so if it is, I mean, if the repurchase price is with the fair value of the asset, okay, then we need to consider this is a sale transaction. It is not the financing transaction. Okay, and if the asset are readily available in the market, in that situation also we need to consider the sale transaction. Okay, if there is a residual value guarantee, if we are giving a residual value guarantee, that means we want to again repurchase at a proper at a price. Okay, so that's why like we need to consider if there is a repurchase residual value guarantee, then we need to consider the financing agreement, because asset has not been transferred. Then sales leaseback. So sell criteria met. So if the criteria are met for the sale, each party must determine whether the transaction is at fair value. Okay, transaction between the related parties do not require this process. To make this determination, two steps we need to required to follow. Asset sell price and fair value, and the present value of lease payment and the present value of the market rental payment. So one of the one that is more determinable, identify any difference between the two data points. Okay, so asset sell price and the fair value. Okay, so I mean, as on today, if the asset fair value is 400,000 and I'm keeping the sell price is 400,000, so I can consider this as a sale and can recognize as a sale. Okay, if the fair value of the asset $400,000 and my sell transaction is for say for 2,80,000. Okay, so I can say means it is basically the mortgage. Okay, and 2,80,000 is basically the finance. So you need to consider the difference between the asset sell price and the fair value. The same is present value of lease payment and present value of the market rental payment. if I'm paying, the present value of my lease payment is less than the present value of the market rental payment, okay, or more than the present lease rental payment is more than the present value of the market rental payment, that is not considered as a lease. It is basically the repayment of whatever the loan I took, okay. So that's why, or the finance I took. So that's why this 2 point we need to consider. Of the one that is more determinable, identify any difference between the two data points. If difference exists, this will require an adjustment to either the sell price or the purchase price. An increase in sale or purchase price will be treated as a prepaid rent via an adjustment to the ROU asset is the leaseback. And any decrease in sale or purchase price will be treated as an additional financing borrowed by the buyer lessor to the sell lessee. If the fair value is 400,000 and the sell price is 600,000, that means, okay, so fair value is 400,000, but I sell it at 600,000. So that is basically like adjustment we need to do the sing. So 200,000 could be the additional financing. Okay, if the fair value is 400,000 and the sell price is 2,80,000. Okay, so remaining 1,20,000 we need to consider as a advance rent. Okay, so if the asset value is 400,000, but I'm getting the 600,000 from the seller, okay, so that means 200,000 is considered as a additional financing. But if the asset value is 400,000 and I'm getting reduced value, decreased value, then I need to consider this as basically the advance rent paid by me. Okay, so we will take a 12-13 minute break here and then we start again. Okay.
Yes, sir.
Yeah. Okay, so can we start now?
Yes, sir.
Yeah. So billing company held equipment on its book with an original purchase price of 500,000 and remaining useful life of 10 years and carrying value is 415,000. Okay. On January 1, year 3, Billings sold the equipment to Crane Inc. for 490,000. Okay. So carrying value is 415,000 and the sale value 4,90,000. Okay. So the equipment at the time of the sale had a fair value of 470,000. 470,000. Okay. So Crane agreed to lease back the equipment to the billing for the 5 year at an annual lease of 112,396.5 due on January each year beginning in the year 4 with an implicit interest rate of 475,000. Okay. So assuming the criteria to qualify the transfer as a sales are met, prepare the journal entry. Okay, so they already confirmed the transaction transfer as a sales are met. Okay, so we do not require to recognize whether it is a sell type transaction or the financing type transaction. Okay, we assume it is a sell type transaction, but here we received excess 20,000, so that we need to consider as a finance liability. Okay, so finance liability or the advance rent we need to consider only when the sell type transactions are is qualified. Okay, so cash account 490,000, accumulated depreciation 85,000. That we need to derive 500,000 to carrying value 415. So that we need to remove. Equipment we need to de-recognize. Financing liability 20,000 and the gain on purchase of the gain on equipment of sale 55,000. Okay, so that we need to calculate the difference between these two. Sorry, 470, like this two, 415 and 470. Okay, so that is basically the difference. This is gain. Gain is basically 415,000 and 470,000. Total amount we received 490,000. Out of this, we consider the 20,000 as a finance liability. So my net sell value is basically the 470,000. Okay. Book value is 415,000. So gain is 55,000. And this way we need to make the journal entry. Cash account debit 490,000. Additional accumulated depreciation and equipment. This is basically the reversal of accumulated depreciation and equipment. And the financing liability, because we got the more amount than the fair value, and gain on equipment on a sale. So gain we need to calculate with respect to the fair value. Upon the execution of the sales leaseback, the two transactions will take place. The sale along with the recognition of profit and loss would be recorded. Note, in order to record a profit and loss, the leaseback will have to be in an operating lease. If this lease were to the owns criteria, it would be treated as a finance lease, essentially the equipment of a repurchase and thereof a failed sale. Okay, so if I'm going to utilize the full life of the asset or going to pay the full amount of the asset, then we need to consider this as a finance lease. We can recognize the gain only in case of the operating lease. So the lease would be recorded based on the same accounting rules as per the other rule, the other lease described in the module. Okay. So first thing, sell lease back, we need to consider for the operating lease. Then sell lease back, sales criteria are not met. That we need to consider this as a finance lease. Okay, so both the seller lease and the buyer lessor will treat as a failed sale as a financing transaction, which will involve the seller lessee recording the finance liability and the buyer lessor recording the financing receivable of the amount received from the other party. In this regard to the asset, the seller will continue to recognize the asset and the buyer will not recognize the asset in the books. If the sale criteria is not met, then we need to consider this as a financing transaction. So, billing company held equipment on its books with a remaining useful life of 10 years and the carrying amount is 415,000. On January 1, year 3, the billing sold the equipment to the crane for 490,000. The equipment at the time of sale had a fair value of 470,000. So, crane agreed to pay to lease back the equipment to billing for a 5 year at an annual lease cost of 112,396.5. So which included the 4 point interest with the 4.75. Assuming that the criteria to qualify the transaction as a sales are not met, so we need to prepare the journal entry. So entire 490,000 we need to consider as a financing. So it is financing liability. Then interest expenses means as per the the present value calculation and the financing liability and the depreciation expenses and accumulated depreciation. So depreciation we are going to consider in the books of lessee. Okay. So interest expenses 490 multiplied by 4.75, which is 23,275, and the depreciation on the carrying value divided by the 10. Okay, so that we need to do. So this is basically this entry we are doing in the books of lessee or the person who is selling the equipment. Any doubt here? So sell we need to consider when there is an operating lease. If it is a financing lease, then you need to consider this as a financing, means whatever may be the we discuss for the financing lease purpose, that we need to consider. Any point, any discussion? No. Okay. Now the financial statement presentation. So balance sheet, a lessor of a cell type and direct financing lease present the lease asset separately from other items on the balance sheet. A lessor of an operating lease continue to report the underlying asset as they normally would, that is the property, plant and equipment. If it is a finance lease, so in the books of lessor, okay, we need to show this as a separate item. Okay, but if it is an operating lease, then you need to show as a normal asset item. Income statement, a lessor will disclose the lease income in the income statement or will indicate the note to the specific line item which include the lease income. And sometimes it is an interest income, so you need to give the note in the disclosure. Then lessor disclosure, the lessor will have to disclose the several qualitative piece of information, including description of the lease, the existence of terms and condition option to extend or terminate the lease, option for the lease to purchase the lease asset, significant assumption and judgment, including whether the contract contains a lease and the allocation consideration between the lease and non-lease component, related party lease, accounting policies, then quantitative profit or loss recognized at the commencement date, interest income, interest related to the operating lease payment received, income from variable lease payment not included in the measurement of lease receivable. Means if there is a certain contingent payment which we are not considered because it is not probable to receive in a lease receivable calculation, then we need to show separately. Component of the net investment in cell type and direct financing lease include the lease receivable, unguaranteed residual asset and deferred selling profit or direct financing lease, minimum lease payment, unguaranteed residual value, indirect initial direct cost and unearned income. Okay. Information on asset that are subject to operating lease, including associated depreciation and impairment, and separate maturity analysis of lease receivable showing the undiscounted cash flow to be received on an annual basis for a minimum each of the first 5 years and total of the amount in the remaining years. Okay, so for first 5 years we need to give a year wise breakup, and then for more than 5 years we need to give a consolidated number. Any doubt here? Yes.
We have, like in the real life, many of the people they sublease the asset also. So what aspect will happen over there?
No. I mean, in real life, in many of the
The many of the companies they sublease the fixed asset.
they sublease the fixed asset. Yes.
So what will happen? What entries we have to pass, or what happen if there is a sale lead back?
Okay.
So at that point, who will be the lesser and what will
Let's
be
see.
the terms and general
Okay.
entries?
So see, first issue is if someone is giving a sublease, okay, that is not allowed as per the agreement. Not allowed as per agreement. Okay. But still, if someone is giving, like there is a say for the huge value asset, huge value asset, okay, and the part of the asset he is giving to the someone, okay. So for him, it is basically the operating only. Okay. Original transaction of the sale and lease back or the financing, this is basically between the original lessor and the original lessee. But if the sub lessee, sorry, the lessees give sublease to the part of the asset, so that is with respect to the condition, because it cannot be, means you cannot say like 100% asset utilization done by the sub lessee, okay, because he can get the part of the asset, okay, or his lease rental or whatever the rent he is going to pay to the main lessee, that cannot be the part of the full value of the asset, okay. So that's why at any point of time that cannot qualify as a finance lease, it is always an operating lease. There is no question of sale and leaseback arises, because the sale and leaseback can happen from lessee side to the main lessor, okay. So even if you sublease it, okay, so sale and leaseback cannot be possible. You can own, I mean, in that scenario only operating lease can be possible. Are you able to get me? If I'm giving,
Yes, sir.
means if I'm just an intermediary and pass on entire thing, okay, so I just need to recognize the income. So then in that case, whatever may be the commission or the additional amount I'm getting it, so I cannot qualify as a lessee. Even the main lessee is someone, okay, but mostly in practical situation sometime it may happen, okay, but that is for the part period, so it is always considered as an operating lease.
Yeah, because
Yeah. Okay. Any other doubt? Any point? Segment reporting.
so the question part you will do now. So
Okay, I'll just finish first. Okay, so this portion maybe we can do the question part in the next week, or if we have a time, so we will do today some questions. Okay. So segment reporting is what I mean when we are doing a business in a multiple product or multiple geographic location, and the like my business volume is more than for particular product or for particular geographic location more than the 10% of total revenue, then it is mandatory to disclose the profitability, asset value, some of the balance sheet item pertains to that segment, okay. So that is basically the segment reporting, okay. So generally the division we need to make or maintain, okay, that is on the basis of the management review, okay. It is not like this, there is a strict rule, okay. Say for management operate in a three division, means they track the profitability with respect to three division. So then you need to make a segmental reporting for this three division only. So it is not like this. There is a further criteria. Okay. I mean the product wise or something like that. So it is always depend on the management review, management reporting. Okay. So the objective of segment reporting is to provide information on the business activities and the economic environment of a company to help the users of the financial statement. So better understand the entity performance, better assess the prospect for future net cash flow, and the make more informed judgment about the entity as a whole. Okay. So required disclosure for all public entities, operating segment, annual and interim. So in every financial, you need to give the operating segment, product and services, geographic areas, major customer, and the title and position of the individual or the name of the group committee identified as the chief operating decision maker. Okay. So why this is important? Because like say for giving an example, unit A, okay, he is a manager, okay, and he report to the, say for head of unit B, okay. So unit A cannot be a separately reporting reportable component. As separate reporting component. Because he is not a decision maker, okay, he is not responsible for profitability of the unit A. The unit A always club with the unit B, okay, because he is responsible for the profitability, cost, investment, everything, okay. So that you need to, that's why the designation or the title and position is very much important in a segment reporting. Use same accounting principle as the main financial statement. So whenever you are preparing the segmental reporting, you need to apply the same accounting principle which you use for the financial statement. Okay. Then intercompany transaction not eliminated. Okay. So if there is a transaction between interunit, okay, that you need not require to eliminate. Means you should not eliminate, not get eliminated, okay, because you need to justify the performance of the unit. So that's why you need to consider all inter-unit transaction as well. Okay. Scope public companies only. Segment reporting applies to public companies only. It does not apply to not for profit organization, non-public companies, or separate financial statement of a members of a consolidated group if both the separate company statement and consolidate or combined financial statement are included in the same financial report. Okay. So segment report we need to do only for the issuer company or the public company. And when there is a consolidation financial statement we are presenting, then we need to consider only for the consolidated financial statement. We do not require to prepare for the standalone financials. Operating segment. Operating segment is a component of an entity that has of the following characters. So it engages in a business activity from which it may earn revenue and incur expenses, including revenue and expenses related to the transaction with the other component of the same entity. If the operating results are regularly reviewed by the chief operating decision maker to make decision about the resources to be allocated to the segment and the asset of its performance, and its discrete financial information is available, means the separate financial information is available. Okay. So just keep in mind, like as I said, means if you are a decision maker or operating segment, we need to consider for which the management is tracking the profit. Okay, that only you need to consider the operating segment. Okay, it is not required, I mean, there is no strict rule which we need to consider for the operating segment. Okay. Corporate headquarter is not an operating segment. Okay. And the pension plan is not an operating segment. Okay. So if you are earning a profit or you are doing an activity, then only then you need to consider this as a operating segment. So that's why these are the exception. Corporate headquarter not an operating segment, and pension plan not an operating segment. Then reportable segment. Reportable segment are operating segment of an entity that meet the criteria for the separate reporting. Okay, so we just need to see this criteria. So those operating segment that exhibit similar long-term financial performance may be aggregated in those single operating segment only if the segment have a same basic characteristics in each of the following areas. Means your customer base is same, your raw material is same. Okay, so you can consolidate it. Okay, so the nature of the product and the service, the nature of the production process, the type of class of customer for their production and services, means type of class of customer means if the customer belongs to chemical industry, if the customer belongs to textile industry, okay, that we need to consider. The method used to distribute the product or provide the services, and the applicable nature of the regulatory environment, that is banking, insurance and public utilities. Okay, so these are basically the criteria you can consider to evaluate what could be the operating segment. Okay, quantitative threshold for the reporting segment means what you need to report. For that there is a quantitative threshold. A segment is considered significant and therefore disclosure is required if it meets one or more of the following quantitative threshold. So you can see that is this you need to three element you need to consider any one of. Okay, so 10% size statement, so it is not like this, all three need to qualify. If any one of this qualify, then you need to report as a separate reporting segment. Revenue, profit, in profit there is a one more criteria because there loss may be happened. Okay, and then the asset. So first what we need to do, what the management is going to see. Okay, means the management has a 3 division, then you need to consider reportable segment as a 3 division only. Okay, okay, this is the first, means the management wish is the first criteria. Okay, they monitor the profitability with 3 segment. Okay, 3 segment. Okay, then we need to consider the 3 segment only, like A, B and C. Okay, A is doing a business of 95%, B and C doing a business of 2% and 3%, say for. Okay, as these are less than 10%, so you can combine this. Okay, so you can show just the A as a reporting segment because it is more than 10%. Okay, B and C, they are 2 and 3% less than 10%, so you can show as a other. There is no requirement to show the separately. That is basically the 10% size. Okay, 10% we need to evaluate revenue. So and the revenue include intercompany, interunit. Include interunit. Okay, so it is not like this, the only financial revenue, whatever may be the total revenue including interunit, that we need to consider. The segment revenue including both sale and external customer and inter-segment sales or transfer, but exclude interest income or advances and loans to other segment. So 10% or more of the combined revenue, internal and external of all operating segment. Okay, so I need to consider the revenue individually, and then I need to see whether it is 10% or not. So here if I see that 95% revenue, okay, so I need to report separately. B and C 2 and 3%, I can report in a combined way or as an other. Okay, for calculation of 95%, the total revenue, I need to consider revenue from each unit. Okay, so even though it is inter-unit transfer, that also you need to consider. Okay, then the reported profit and loss. So absolute amount of the segment reported profit or loss is 10% or more of the greater. Okay, so the combined report of profit of all operating segment that did not report a loss, and the combined report loss of the operating that did not report a loss. So see what happened. Like I'll consider A, B, C, D. Okay, here the 1000 profit, 200 loss, 1000 again, and 800 loss. Okay, so it is not you need to do the total for profit. What you need to do, okay, 1000 and 1000, 2000 is in profit, 2000 is profit, and then you need to evaluate the 10% or loss minus 1000. Okay, as the loss is less, so we need to consider the profit as an base for the calculation of the 10%. If the loss is more, like instead of 2,800, so it is 3,000. Okay, so you need to consider this as a base for the 10%. Okay, you do not require to knock off. Okay, what you need to do, you need to calculate the separately total profit, and you need to calculate the separately total loss. Okay, and then whichever is higher, that you need to consider for the calculation of the 10%. Hope I am able to explain properly. Okay, so this profit we need to add, this loss we need to add, and then we compare which is higher. So as the loss is higher, so we need to consider 300, I mean the 10% of 3,000. We need to consider the 300 as a like threshold for reporting segment. An asset, the segment's identifiable asset at 10% or more of the combined asset of all operating segment. The asset of a segment are those assets, including the measure of the segment asset, that are reviewed by the chief operating decision maker. So that we need to consider. Okay. So again, in a sales, we need to consider the inter-unit sale as well. It is not like this. We need to match the total sale with the financial statement. No. Okay, you need to calculate the total sale executed by the each unit, then we combine together, and then you need to calculate the 10%. Profit and loss, either you need to consider the profit of all division, I mean the division, those divisions reported the profit, or you need to consider those divisions reported a loss. Okay, and then whichever is higher, then you need to compute the 10% amount. And the asset is as it is, I mean that is no much complexity. Okay. Then 75% reporting sufficiency test. Okay, so if the total external consolidated revenue reported by the operating segment constitute less than 75% of the external consolidated revenue, additional operating segment need to be identified as a reportable segment. Okay. 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 See what happened. Okay. So here it is like this ABC. I will take the 6th division. No, I mean we need to E, F, actually A, B, C, D, E, F, G. Like it should be means n number of division. Okay. Only like this division is a 40%. Okay. Or 60% I can say. Okay. And the remaining is basically the 5%, 7%, 8%, 10%, 12%, like sorry, 2%. Okay, like this. And here also 3%, like this. Okay, and so on. So reportable segment is 60% only. Okay, but minimum 75% you need to recognize. So what you need to do, then you need to additionally reflect this 7 and 8%. Are you okay? See what happened, minimum 75% we need to report. Okay, so one unit has a 60% and remaining is not qualify for the 10%. Okay, but as the total external revenue from this segment is not the 75% of the total consolidated revenue. Consolidated revenue. And this calculation we need to do on the basis of the external. Okay, what I did means the total revenue considered here, then I extracted the external revenue for all the department. Okay, and then when I apply the total external revenue, then I find the 75% is not considered. Means the external revenue department A, B, C, and D, when I total it and compare with the total external revenue, so it will not cover the 75%. So that's why this we need to disclose additional reportable segment, so that we need to complete the 75% of the total external revenue. Are you clear on this? Anyone has any doubt?
So all the reporting things should be less than 75%.
No, it is not like that. We need to reach the total 75%. Say for A, B, C, D, E. Okay. So here the consolidated external revenue. Okay. Like here the external revenue is 5 lakh. Okay. And the total external revenue is basically the 10 lakh. Okay. Remaining basically the like 50,000. 1 lakh, not 1 lakh, 90,000. Okay. So we cannot consider. But if you see this also cover only 50%. And I need to bring to the 75%. Okay. That I am talking about only external revenue. You need to report on the basis of total revenue. Okay, then you need to again calculate whether whatever the segment you reported, whether this completed 75% external revenue with respect to the total external revenue. If it is not complete or fulfilled, then you need to identify additional reporting segment so that you can complete the 75% external revenue. Okay, see, first you need to consider, means if I consider the only revenue, you need to report on the basis of total revenue, including the inter segment revenue. Okay, then you need to calculate whatever the segment you reported, whether it constitute 75% of the external revenue. Okay, so 75% external revenue of reportable segment. Okay, whether it covered or not. If it is not covered, then you need to identify the additional reporting segment so that you can complete the 75% external revenue. Internal, external, are you able to understand? I'll give an example. Okay, total and external. Okay, I consider here 15 lakh and here 10 lakh. Okay, so in 15 lakh, this is basically the 9 lakh. Okay, 6 lakh. Yeah, 9 lakh. And then 1 lakh 25,000. 1 lakh 25,000. 25,000 and 1 lakh 25, for example. Okay, so it may not be 14 lakh. Okay, so there are some F, it is basically the 1 lakh. So if you see, this will become the 15 lakh. Okay, so this itself only the reportable segment, rest are not, because the 10% criteria not met. Okay, out of this, say for this is like 7 lakh external. Okay, and the remaining is basically external in everywhere. It is basically 75,000, 75,000, 75,000. Okay, 50,000 and 25,000. These are the external. If I consider this only reportable segment, so it is basically the 70%. So here comparing the external revenue, not this one. Okay, I need to bring it to 5%. So I need to evaluate. Okay, so like additional 5%. Okay, so additional 50,000, at least one reportable segment I need to consider again, so that it will be 75%, like this 75,000. Okay, this and this will constitute the 75% of the 10 lakh. Okay, so this way we need to evaluate. 75% sufficiency test we need to calculate on the basis of external only. Okay, 10% test we need to calculate on the basis of the unit cell. Clear with this? Any doubt? Okay. Then all other segment category, information about other business activity and operating segment that are not reportable based on the above criteria should be combined, and we need to show in a all other segment. Okay. So that is,
Sir, I have a doubt.
yeah,
So this all reporting which you're telling, it's in the financial statements or in the tax statements?
in the financial statement.
Fine. Okay. Okay,
Okay.
sir. Got it.
Not on tax statement. Okay. Then comparative reporting. Okay. Before going to this, I'll just revise once again. Operating segment, we need to consider on the basis of decision maker, that you need to keep in mind. Second, 10% for revenue, you need to calculate the 10% test on the revenue, including the inter-segment transfer. Okay. Profit and loss, you need to calculate the total of all profit or all loss, and accordingly you need to decide the threshold. Asset is simple. 75% test you need to apply on a only external revenue. Only external revenue. That also you need to keep in mind. Okay. Then comparative reporting. So an operating segment that was deemed to be reportable in the immediately preceding period, but that does not meet the criteria for reportability in the current period, may continue to report separately if the management judge the segment to have a continuing significance. Okay. For a particular year, if you are, the 10% criteria is not met, still you need to report because you reported in a last year. So it is basically operating segment. If an operating segment that was not deemed to be reportable in the prior period meets the criteria for reportability in the current period, the segment data for prior period presented should be recast to reflect the newly reportable segment as a segment period. So, if you need to report additional segment in current year, segment in a current year, okay, in that report additional segment in current year, then previous year data you need to present for that segment. Even if you have not previous year need to present in a previous year data need to present in a need to present for that segment. So that you can maintain the comparability. Then segment profit or loss defined. So segment profit or loss is calculated revenue directly traceable cost less reasonably allocated cost, and that is my operating profit. Okay. So when we prepare the consolidated financial statement, okay, so we are just mentioning the direct traceable cost and then gross profit and then the other expenses. Okay. But when you are preparing the segmental reporting, okay, so you need to allocate the indirect cost, okay, with some reasonable basis, and then you need to calculate the operating profit. Income and expenses allocation. The income and expenses are not allocated to segment unless they are included in the determination of the segment profit or loss reported to the cost. Item normally excluded from segment profit: general operating revenue, general corporate expenses, interest expenses, income taxes, equity in earning and losses for unconsolidated subsidiary, gain and losses from discontinued operation, minority interest, that we need to reduce. Okay. We are not going to consider. Okay. Rest we need to consider. So here if you see, like general corporate revenue and the general corporate expenses, so it is not like this. The unit admin expenses we need to remove, that we need to maintain as it is. Other measure, the CODM may review the measure of profitability or loss each identifiable segment. Entities may disclose this measure in addition to the segment profit and loss in the financial statement. Okay. Yeah. And then the disclosure. Identifying factors. Factor used to identify the entity's reportable segment that we need to disclose means how you identify, means on what factors you have decided these are basically the separate reporting reportable segment, like it is the product and service wise or geographic area wise or regulatory environment wise. Product and service, the type of product and service from which the reportable segment derive its revenue must be disclosed. So profit and loss, this all we need to consider. So revenue from external customer, revenue from transaction with other internal operating segment, interest revenue, interest expenses, depreciation, depletion and amortization, unusual item including unusual event and transaction, equity in the net income investee, amounted by the equity method, income tax expenses, significant non-cash item other than depreciation, depletion and amortization, significant expenses and other expenses. So most of the expenses which you need to disclose in a reportable segment. Only corporate expenses we are not consider, because the unit activities not depend on the corporate expenses. Okay. So public entity should also include the description of significant expenses included in the determination of the significant profit and loss and description of what makes up the other expenses for each reportable segment. Otherwise, you need to disclose the separate SGA, selling and general administration expenses in the reportable segment. Then asset, the amount of investment in equity method investee and the total expenditure. So addition to long-lived asset other than the financial investment, long-term customer relationship of a financial statement, mortgage and other servicing right, deferred policy acquisition cost and deferred tax assets. Okay. So in asset, we consider only those investment where we apply the equity method. Okay. So like we know, either the cost basis, equity method and the consolidation. See, try to understand. Whenever we do the investment, means refer this line, the amount of investment in equity method investee. Okay. If it is a cost basis, so it will not affect to my operating profit. Okay. It is just purely the investment income. Okay. When I acquired the share less than 20%. Okay. If it is more than 50%, then we do the consolidation. So in a standalone financials, or there is no need for segment reporting. Okay. Only equity method we are using, means the acquire is more than 20% and the less than 50%. If this is the situation, okay, so then and only then we need to consider this. Then and only then we need to consider this as an asset. In the asset amount of investment in equity method involved, because the profit of this unit, okay, we need to consider as a profit in our income statement. So that we need to recognize as an asset. Okay, so that you need to keep in mind. Why the amount of investment in equity method investee? Okay, so if it is a cost basis, we are recognizing the investment. We do not require to consider as an asset. If we acquire the more than 50% of a stake in a particular entity, then we need to go for a consolidation. So again, we do not require to recognize as an investment. But if we apply the equity method for a particular investment, then we need to recognize this as an segmental asset. Measurement criteria. The accounting principle used for segment reporting may not be the same as those used in the prepare the consolidated financial statement. Some principles are not expected to apply on a segment basis. Therefore, the following information must be disclosed. Okay. So when we are doing a consolidated financial statement, sometimes the standalone financial statement is not in line with the accounting principle adopted by the consolidated financial statement. If this is the situation, then you need to give the disclosure. The basis of accounting of any internal transactions, the nature of any differences between the measurement of the reportable segment profit or losses and the entity's consolidated income, the nature of any differences between the measurement of the reportable segment asset and the entity's consolidated asset, if not apparent from the reconciliation, if it is not apparent from the reconciliation provided. The nature of any changes from the prior period in the measurement method used to determine the reported segment profit and loss account, and the nature and effect of any asymmetrical allocation to the segment, and how the CODM uses the reported measure of a segment profit or loss in assessing the segment performance in deciding how to allocate the resources. That is basically the measurement criteria. And then the reconciliation, you need to provide the total of reportable segment revenue to the entity's consolidated revenue. So whatever may be the intercompany revenue, that inter-segment revenue, that you need to show separately. The total of reportable segment measure of profit and loss, entity's consolidated income before the income taxes, discontinued operation, and the cumulative effect of the changes in accounting principle. That also we need to provide. The total of the reportable segment asset to the entity's consolidated asset, that also we need to provide, and the total of the reportable segment amount for every other significant term of the information disclosed to the corresponding consolidated amount. That is also we need to provide. Okay, so these are basically the reconciliation or the amount which differ from the reportable segment. Okay, so we need to just give a justification in the reconciliation. Then entity-wide disclosure. Okay, so means whatever we discussed, this is till now, that is basically the disclosure for the reportable segment. Now entity-wise disclosure. So it is basically the product and service revenue from the external customer for each product or service or each group of similar product and service must be disclosed unless it is impracticable to do so. Okay, so for each product and service we need to disclose what are my external revenue and what are my internal revenue. Okay, then geographic areas revenue attributable to the entity's domicile country, attributed to foreign countries if the amount is material, attributed to the individual foreign countries if the amount is material, and the basis of attributing revenue from the external customer to the individual countries. Okay, so this also we need to provide. So mostly we need to give revenue bifurcation in a domestic country, total of the foreign countries, individual of the foreign countries, and the customer wise foreign countries. Okay, long lived asset located in the domicile country, located in all foreign countries in total in which the entity hold the asset, and located in individual foreign countries if the amount is material. Major customer also we need to give. An entity that generates 10% or more of its revenue from the sale to a single customer must disclose the fact that total amount of revenue from each such customer and the identity of the segment or segment reporting the revenue. So identity of the major customer need not be disclosed. So you do not require to give the customer name. Okay, but like if there is a single customer or group of customer, then you need to disclose the reporting on the basis of those customer. Then reporting requirement of regulation SX. So that is basically Sarbanes-Oxley Act. Means we need to present some interim financials as well as the annual financials. Okay, so requirement for the interim financial statement. So review requirement. Interim financial statement filed with the SSE must be reviewed by the independent public accountant, and the review report must be filed with the financial statement. Okay, so like interim financial, we need to get it reviewed by the independent CPA. Okay, so it is not the audit, but there is a limited review. Okay, so in limited review, he is just doing some analytical procedure, and he confirmed that nothing is report which is inconsistent with the accounting policies or any other aspect of the financial. Okay, statement and period presented. So interim financial statement should be included the following: the balance sheet, income statement, statement of cash flow, means the same thing, all the five adjustment for the fair okay, statement of cash flow, and the statement of changes in equity, and the notes to account. That all we need to provide in the interim financial statement. Okay, so balance sheet as of the end of the most recent fiscal quarter and as at the end of preceding fiscal year. May also include balance sheet as at the end of the corresponding fiscal year for the preceding fiscal year if necessary to understand the impact of the signal fluctuation. So end of the most result means year to date, and you can also add particular quarter. Okay, but that is maybe, it is not required, but year to date you need to provide. income statement for the most recent fiscal quarter for the period between the end of preceding fiscal year and the end of the most recent fiscal quarter and for the corresponding period of the preceding fiscal quarter. May also include income statement for the cumulative 12-month period ending during the most recent fiscal quarter and for the corresponding preceding period. So that is also not mandatory, but if you can, if you want, you can produce like the first quarter end on a March. Okay, so April to March information also you can produce. Okay, the statement of cash flow the same for the period between the end of the preceding fiscal year and the end of the most recent fiscal quarter and the corresponding period for the preceding fiscal quarter. May also present a statement of cash flow for cumulative 12-month period ended during the most recent fiscal quarter and the corresponding fiscal preceding period. Then adjustment for fair presentation. So interim financial statement may be condensed financial statement and should reflect adjustment necessary to fairly state the result of the interim period with a statement to that effect included in the notes to the financial statement. If all such adjustments are of a normal and recurring nature, a statement should be made to the effect. The financial statement should include detailed description of the nature and amount of adjustment that are not normal recurring adjustment. So sometime what happened, there are certain entries which we do on year end only. Okay, but when we are issuing the consolidated interim financial statement, we can give the impact of that year end adjustment. Okay, and that means whatever may be the year end adjustment, year end adjustment, that we need to give the notes. Okay, see what happened. Say for depreciation entries that we are pass on year end only. Assume. Okay, but in the consolidated and interim financial, not consolidated, interim financial report, even if we have not passed the depreciation entry, we need to give the effect in a financial. In a financial, give the effect in a financial, and then give the effect in a financial, and then accordingly give a note on it. Okay, so that you need to consider. Okay, so disclosure requirement means like there are certain entries which we are not doing on a quarterly basis. Okay, or there are certain impact which like the provision for the contingent liability. Okay, so that we are not going in a very detailed way. Okay, so on a estimated basis we need to keep some provision and we need to give the disclosure for that. Then disclosure requirement. So omitted disclosure because the users have access to the most recent annual financial statement. Interim report may omit the summary of significant accounting policy, the detail of the account that have not changed significantly since the end and most of the recent fiscal year, and the detailed annual disclosure described below. So because we already issued the audited financial statement for the prior period and we already mentioned the notes to accounting principle which we adopted in the notes of the audited financial statement. So if there is no change, then you can omit that disclosure. Required disclosure. Disclosure should include events subsequent to the date and most recent fiscal that have material impact on the entity, including changes in accounting principle and practices, including the date of and reason for the change in estimate, changes in the status of long-term contract, and significant new borrowing or modification of the financing arrangement and the business combination or development. So whatever may be the situation happened after the closure of the previous financial year, okay, and before closing the interim financial report, okay, so and which affect the position of the previous fiscal year. So that disclosure we need to give here. Then the requirement for the annual financial statement, audit requirement. Annual financial statement filed with the SEC must audited by the independent public accountant, and the audit report must be filed with the financial statement. So annual financial statement, it is detailed audited. Okay, statement and the period presented. The audited financial statement must include the following: balance sheet for the two most recent fiscal years. Okay, income statement for each of 3 fiscal year preceding the date of the most recent audited financial statement. So income statement we need to produce for the 3 fiscal year. Okay, balance sheet we need to produce for the 2 most recent fiscal year. Okay, so that is the difference. Statement of cash flow for each of 3 fiscal year. Cash flow in the income statement we need to produce for the 3 fiscal year. Changes in owner equity for each of the 3 fiscal year preceding the date of the most recent audited financial statement. Okay, so statement of cash flow, income statement, and the statement of changes in cash flow that we need to present for the 3 fiscal year, whereas the financial we need to produce for the 2 fiscal year. Then disclosure requirement. So these are the disclosure we need to give: dividend per share and the total of each class of the shares, principal consolidation or the combination, assets subject to lien, default with respect to any issue of securities or credit arrangement if the default or breach existed the balance sheet date and has not been subsequently cured. So when we take a loan and there is a certain condition of the loan, and if we are not able to do it, we are not able to comply with the condition, and even while issuing a recent financial year we are not in position to complete those conditions, then we need to disclose it. Okay, preferred share disclosure. Restriction the limit of the payment of dividend, means if there is a restriction, means a statutory restriction, say for you need to maintain the general reserve for some amount, so that also we need to disclose. Significant changes in bond, mortgage, or the similar debt, means if there is a changes in the loan or the any financing arrangement, that we need to disclose. Okay, means it should be the significant change. Then summarize financial information of subsidiaries not consolidate and 50% or less owned entities. Okay, so if we have a certain other investment which we are not going to consolidate, for that also we need to give the information. Income tax expenses, warrant or right outstanding, related party transaction which affect the financial statement, repurchase and reverse repurchase agreement, and accounting policies for the derivative instrument. Okay, so these are basically the disclosure requirement. Reporting requirements of regulation SK. So business item 101, 105. So these are basically what happened, means some ad hoc disclosure you need to give. Okay, some ad hoc disclosure means there is a change in management, so you need to give the those disclosure in the form SK. Okay, so like okay, so like SX basically related to the interim. Annual return they have not given, but there is a separate section for annual return, and the ad hoc information you need to give in a regulation SK. So business item include description of the business, property, legal proceeding, mine safety disclosure, and the risk factor. A principle based disclosure regime allowing the registrant discretion to determine what merit disclosure based on the materiality. Means any significant impact on the business that you need to disclose to the registrar. Okay, through form SK. Registrant securities include information on the market prices of the common equity, dividend of the common equity, and the security description. Financial information include related to the financial data, supplementary financial information, management discussion and analysis, changes in disagreement with the accountant, quantitative and qualitative disclosure about the market risk, and consolidate and procedure and internal control. Okay, so if any deviation or any disagreement, okay, so that you can report through the financial information through regulation SK. And management and certain security holders, so include information on directors, executive compensation, security ownership of certain beneficial owner and management, so related person transaction, exchange act compliances, and code of ethics and corporate governance. So if the managing director get changed, then you need to disclose this to the registrant through the regulation SK. So that is basically the management and certain security holders. Then registration statement and the prospectus provision. So if you want to get the public finances, okay, so then you need to disclose those information. So includes cover page, the prospectus summary, how the proceed will be used, offering price determination, dilution, selling security holder, distribution plan, interest of the name expert and counsel, disclosure of the commission position, and other expenses, issuance of the distribution undertaking. So this information also you need to provide in a registration statement. So whatever may be the information you are giving in a prospectus to attract the investor, that also you need to provide. Exhibit relate to the exhibit that typically accompanying the filing of the various SEC required forms. So whenever you are filing the SEC form, so you need to file some exhibit and the industry guides. So relate to the disclosure requirement of a particular industry and the roll-up transaction. So there are less frequently seen situation involving private firm merging into the larger company. So if this is the situation, then also you need to disclose. So these are basically the ad hoc disclosure. Okay, interim audit report or the annual audit report that you need to provide on a yearly basis. But whatever may be the ad hoc disclosure that you can give it to the regulation or the registrant through the regulation escape. XBRL reporting requirement. So this is basically how I can say, because see, every industry or every company, they are preparing the financial statement in their own fashion, even though there is a structured requirement, like we need to show the 2 years balance sheet information and 3-year profit and loss account or income statement, cash flow, or the statement of changes in equity. But the like the communication expenses, traveling expenses, these are the different nomenclature we are using. Okay, so comparability is difficult. So that's why like there is a introduction of the XBRL reporting. So here there is a particular XBRL terms or the tag. Okay, against that you need to map your expenses head. Okay, and once you map the expenses head, the XBRL is basically the database management actually. Okay, so they are prepare a financial in such a way that you can compare with the other companies. Okay, so that is basically the XBRL. So generally, even in India also, we need to file the financial statement with the ROC in a XBRL format. Okay. So it is basically extensible business reporting language. Okay. So that is basically the XBRL. So is a royalty-free open specification for the software that uses XML, extensive markup language, data tags to describe the financial information for business and financial reporting. Okay. XBRL is a next generation language after HTML and tell computer how the display text. XML and XBRL tell computer how to interpret the context of the text. Okay. And the purpose and objective is basically to ensure the comparability. So XBRL was designed to provide economic format for financial and business reporting with an overall goal improving the way in which data is communicated. So application of XBRL tag defined below applied to the financial statement allow computers to search and assemble information quickly so that the data can be accessed and analyzed by the financial statement users. Through XBRL, machine-readable financial statements are available real-time in a digital format, and this enables the automated data collection, provide faster access to the financial information, financial statement data, and facilitate the more robust data analysis. Okay, so you need to understand what is tag and taxonomy. So tag is basically code that gives the standard definition for each line item in an income statement, cash flow statement, balance sheet, or other financial information, including the data contained in the notes in the financial statement. Tags include descriptive label, definition, reference to the US GAAP, and other elements that provide contextual information. Taxonomy defines the specific computer reliable tag used for individual item of a business and the financial data. See, like communication expenses. Okay, so communication expenses is basically the taxonomy, but what are the expenses covered here? That is basically the tag. Okay, this way you need to consider, like telephone expenses we need to cover here, communication. Okay, that is basically the tag. Okay, So XBRL US GAAP financial reporting taxonomy. The XBRL US GAAP taxonomy is maintained and updated by the FASB and the Financial Accounting Foundation to reflect the changes in US GAAP and SEC financial statement disclosure requirement, as well as the changes in common reporting practices. SSC reporting taxonomy, a taxonomy that include the element necessary to SSC requirement for financial statement schedule and disclosure. Okay, tag is basically the like the expenses head. Okay, and taxonomy means they gave a standard expenses head. Okay, so that is basically the SEC reporting taxonomy. Then global ledger taxonomy, a taxonomy independent of the others of a reporting standard system type that permit flexible and the multinational consolidation. Okay, so means whatever may be the taxonomy adopted globally, that is covered here. Industry specific, the same taxonomies have been created to accommodate industry specific financial reporting needs. So industry specific taxonomy exists for the commercial and the industrial banking and saving, real estate, insurance and broker industries, and company specific tags. So companies can create their own tags when needed. Tags are not included in the existing taxonomy. Means if the taxonomy is not given, then they can create a separate tag. Then SEC interactive data rule. So SEC's interactive data rule requires US public company and foreign private issuers that use US GAAP to present the financial statement and any applicable financial statement schedule in an exhibit prepared using the XBRL. So exhibit is required with the filer's SEC registration statement, quarterly and annual report, and report containing revised or updated financial statement. So whatever may be the data you need to provide by the issuer company or the any foreign company, they need to provide the data in a XBRL format. Then data tagging details. Okay. So level 1, each complete footnote and schedule tag in a single block of text. Okay. So means whatever may be the some expenses. Okay. So that we need to fit in a single block. Then each significant accounting policy within the significant accounting policy footnote is tagged in a single block of text. Then each table with each footnote or schedule is tagged in a separate block of text, and with each footnote or schedule, each amount, that is monetary value, is required to be separately tagged. Means what happens whenever you are like say for the communication expenses, then corresponding ledger. Okay. Accounting principle you have adopted. Okay. Then I mean, is there any amount like after that there is an amount? Okay. So this way we need to tag with each other. So that is basically level 1, level 2, level 3, level 4. This way we need to do it. Then inline XBRL, an inline XBRL format which embed XBRL data directly to the HTML document is required by the SEC for periodic end or the interim financial reporting. So output is a single format that is readable by the both human and the machine. The objective of inline XBRL are to make the financial information more usable and machine readable while providing the more consistency in the reporting and giving companies a more platform to communicate their stories to the financial statement users. Okay, so whenever you fill the data in a XBRL, so you will get the output in an HTML format which can be used by the human brain as well as the machine.
Sir, what is the weightage of each chapter, sir, in this module?
No, XBRL, you will not get the much weightage. Mostly in this like the call option, put option, leave encash, lease accounting. These are the more weighted item. Okay, so
And stock compensation and all other chapters.
which one? Which one?
Stock compensation.
Stock compensation. You may get some question. Okay, so I think we can stop here today, and then we'll continue in a next class. And next class we will take the practical questions. Okay.
So today class is only till now, not like till 11:30, no?
No, because it is too heavy. So I think
Okay,
is
sir.
it? I'll just drop the message. If you people are available in evening, then we can do in an evening. Otherwise, we can take a 3 hours only.
Okay, sir.
We can pick up next week, sir.
Yeah. Okay, no problem. Okay then. Bye everyone.
Thank you.
Yeah, thank you.
Thank you, sir.
Yeah.